You have probably seen the scary headlines. Everyone is saying that the market is crashing and there's nothing anyone can do about it. They are screaming that the property bubble is finally popping. And if you are a beginner trying to figure out if you should buy your first home or your first investment property right now, you're probably feeling completely paralyzed. You're asking yourself, is the Australian property market crashing? Am I about to buy a house today only to watch its value go to zero next month? It makes absolute sense to feel nervous. The latest data is real. The national home values have officially dropped for the last 3 months, April, May, and June 2026. In June alone, the market took a 0.3% dip. First home buyers are backing off and the properties going to auctions are getting passed in. But while everyone is panicking and putting their property dreams on hold, the smartest property minds across the country are quietly smiling. Today, we are stripping away the media hype. We are going to break down the exact data from PropTrack, Cotality, and Australian Bureau of Statistics to show you exactly the mechanics of a cooling market and why this correction is a beautifully hidden buying window for your family. If you are new here, hi, I'm Adeal from Ariza Buyers Agency, where we help Australian families build lasting wealth, giving you the freedom to enjoy your life on your terms. So if you like content like this, click subscribe as we got more educational content coming your way. Let's start with the facts so we know exactly what we are dealing with. According to the PropTrack Home Price Index released in July 2026, the national home prices dropped by 0.3% in June, pushing the national median home value to $903,000. Now, this isn't just a single bad month. It is third consecutive month of declines, pushing prices roughly 0.9% below their March peak. Similar data from Cotality shows an even sharper trend, showing that the national home values for capital cities dropped by 1.3% over the June quarter. At the same time, the combined capital city auction clearance rates that used to comfortably sit in the high 60s are now sitting below 50%, the worst auction clearance rate since COVID. So if you see these numbers, it looks like everything is going down and there is no hope left. But let's look under the hood to see what actually is driving the fall. The drop is primarily driven by the two largest and most expensive cities in the country, Sydney and Melbourne. Sydney values fell by 3.2% in the June quarter, while Melbourne prices dropped by 2.6%. Now, because these two markets represent the largest chunk of Australian real estate in terms of value, their downfall drags the national average as well into negative territory. Now, this isn't a market-wide collapse. This is a long-awaited correction that we all have been waiting to arrive since 2020 just to make things a little bit more affordable for everyone. The high interest rates with RBA cash rate sitting at 4.35% combined with high cost of living pressures have finally maxed out what most people can borrow on a $75,000 median income. The market isn't broken, it has simply hit an affordability limit. For a buyer, this means that urgency is leaving the room. The FOMO of the last few years is officially dead, shifting the negotiating power straight back to you. This brings us to the second most important factor that the news completely ignore. There is no single Australian property market. We are currently navigating an extreme, multi-speed property market. Now, while Sydney and Melbourne are taking a hit, other capital cities and good regional centers are holding firm or even moving completely sideways. Now, let's look at the contrast in annual performance according to Cotality's mid-2026 data. Melbourne was the weakest performer, in fact the only capital city where the median house prices dropped by 1.1% over the last 12 months. Sydney only increasing by 0.5% in the last 12 months. Brisbane and Adelaide slowing down considerably as compared to their 2025 growth, but still up by 13.9% and 11.9% year-on-year respectively. Perth is growing in a world of its own, showing an impressive 17.1% annual growth despite the recent winter slowdown. Now imagine you are looking to buy a house in Sydney. Because the average mortgage size for a house in Sydney is much bigger, it is very sensitive to interest rate changes. As buyers hit the borrowing capacity, the sellers are forced to adjust their expectation. House values dropped by 0.4% across capitals in June. But look at units and apartments. They actually outperformed the houses because buyers are now looking at more affordable options. So if you are asking, is the market crashing? The answer is, if you are looking to buy an overpriced luxury house in Sydney's northern beaches, then yes, it is correcting down. But if you are looking at an affordable entry-level house in regional Victoria or regional Queensland or regional Western Australia, those markets are holding firm at record highs. Now, where the property is actually located is dictating the market. Now, let's address the ultimate fear holding most people back. People see the auction clearance rates in the 40s, they see total capital city home sales sitting at an all-time low since 2020, and they assume that we are heading into a 2008 financial crisis style meltdown where the banks start seizing homes. This is what I call the inventory illusion. Because people can't borrow as much money from the bank, houses are sitting on the market for longer. Investors who wanted to make quick money by selling their property are now starting to be cautious. They are now realizing that it's better to wait for the market to settle or even recover in their favor before they bring their investment into the market. Now, this is where you can step in and negotiate the best deal for yourself. And here's why it may work for you. Strong equity buffers. Most Australian homeowners are sitting on massive capital gains from the past 5 years. The national median price is still 5.8% higher than what it was 12 months ago. Resilient labor market. Unemployment remains historically low. As long as Aussies have jobs and they can pay their mortgages, the demand will stay for property. Absence of forced selling. Because households have equity, if someone faces financial trouble, they can simply sell their asset and pocket the profit. They aren't going to default. A real estate crash requires massive, panicked, forced selling. What we have right now is simply a mismatch between what sellers expect and what buyers can afford. Sellers are slowly realizing that they can no longer demand unrealistic prices, which is bringing them back to the negotiation table, which means they are finally open to realistic offers. If the short-term outlook shows that the prices are declining, then why on earth should you consider buying a house right now? Why not wait for 2 or 3 more years for prices to drop even lower? And the answer to that is because Australia's structural supply crisis. I think I talk about this in every video, but this point deserves to be repeated just to give everyone the context of problem that we are facing. The Australian government set a massive target to build 1.2 million new homes to fix our housing shortage over the 5-year period. To achieve that, Australia needs to build 240,000 new homes every single year. Now, in the last video, we told you that the government is running way behind schedule to that. And in the budget, the government even acknowledged that they will be building 35,000 fewer homes in the last year. I guess that is due to the sky-high construction cost, labor shortages, and the builders going bankrupt, which they clearly avoided saying because their policies, their taxes, their measures are actually supposed to solve these problems, isn't it? At the exact same time, ABS confirms that our population is growing at a rate not seen ever before. We have more people arriving, but we are building fewer homes. And this is why the national rental vacancy rate is sitting at a critically low 1.6%, while the annual rents have gone up by 5.7% in the last 12 months across the country. In Sydney alone, the rents have gone up by $50 a week since the budget was announced 2 months ago. Think about this logically. You cannot have a property crash in a market where there's a literal shortage of physical houses to meet the population demand. The current price drop is a correction caused by the interest rate hikes and the budget changes. The moment RBA hints that interest rates are going to come down, which some of the major lenders have already hinted for the end of 2026 and early 2027, the demand will spring back and will bring thousands of waiting buyers back into the market. And the prices will have no other option but to reflect the higher demand. Okay, so how do you play this market as a beginner without making a mistake? If you're asking, should I buy a house right now? The short answer is yes, only if you abandon the old playbook and understand these 3 rules. Number 1, capitalize on a falling market. Now, in a hot market, the buyers have to move the world to get a decent house. In a falling market with the auction clearance rates in the 40s, the power flips. Look for properties that have been on the market for more than 45 days. Look for vendors who have already bought or are looking to buy elsewhere and are keen to offload their current property. Now, this is your window to submit offers that meets your budget and goals, with terms like a longer settlement or a lower deposit. Number 2, focus entirely on capital growth fundamentals. When prices are moving sideways or slightly down, you cannot afford to buy a mediocre property. Avoid those high-density, high-rise apartments or developments with unlimited land supply. Focus on land to asset value. Buy in established suburbs where supply is physically locked out and the demand is driven by top schools, top infrastructure, and good job connectivity. Number 3. Run your numbers at a worst case scenario. Right now, commercial banks are assessing your borrowing capacity using an APRA mandated 3% serviceability buffer. If your variable mortgage rate is 6.5%, the bank assesses your ability to pay the mortgage at 9.5%. Follow their lead. Make sure that even if the interest rates stay higher for a longer period of time, your household budget has a comfortable cash cushion to cover for it. Always have an emergency fund before even you make an offer. The property market isn't crashing, it is correcting itself. And history shows us a very clear psychological pattern. The buyers always want to buy when the market is booming and everyone is talking about property in the barbecues, even if that means that they are paying the highest price for that property. But the moment the market cools, the listings pile up, the competition dries up, the buyers hesitate. Everybody goes silent. They wait for the news to tell them that it's safe again. By the time the news tell you that it's safe again to buy, the interest rates would have dropped, the consumer confidence would have gone up, and you will be walking straight into packed auction rooms with a lot of competition already for the same property. And I'm sure you don't want to fight 50 desperate buyers because that just pushes the prices up. The decline we are living through right now is a gift for all intelligent investors. It is a filter that clears out casual competition and gives you the breathing room to buy a quality asset at a realistic price. Don't let the media panic stall your family's path towards financial freedom. Click the link in the description below to book a call with our team where we will go through your situation, analyze your numbers, and map out a customized roadmap to help you buy your next property. Stop watching the news, start following the data, and let's build your property plan together. I'm Adeal, and I'll see you on the call.